Everybody, it's Dr. Joe's in the house on this, nice day. Hopefully it's good. The weather's good wherever you are. It's very nice here in the Washington, D.C. area. And I'm back in town. I just went for I was in Cancun, Mexico. Just got back a couple of days ago and had a real nice time. I was a guest speaker at a real estate mastermind group, Eric Brown's. Very, very nice. And kudos to Erica. A fantastic location, fantastic mastermind, and good sharing, great information with the attendees. It's a fantastic place. Stayed at the Ava up in Cancun, Mexico, by the beach. Very, very nice. It's like a five-star hotel, resort, all inclusive. It's brilliant. One of the best places I've stayed in. And so on. Anyway, so today we're going to talk about tax benefits and considerations for landlords. It's for those people. Obviously, it's April, and for a lot of people getting ready for filing taxes and so on. So I thought I'll do a session just about some of the tax benefits and considerations for landlords like you and I, and so on. So. With that said and done, I'm going to get right to it. My first disclaimer, I suppose I must say, I am not a CPA, and I do not profess to be one. So all the information presented today is really of a general nature, and so I strongly recommend that you seek advice and counsel of professionals such as CPAs, attorneys, bookkeepers, giving your specific situation. So so I do recommend. I'm a true believer in CPAs. I do have a CPA myself. I do have a bookkeeper myself, and I don't believe in trying to do this all by yourself, especially if you have a complicated tax situation and you have lots of properties and so forth. So anyway, so let's get going. So I suppose the first question is going to be, if you're tired of watching real estate or your rental income, I suppose, disappear at tax time, or worried about missing sort of money saving opportunities. You're not alone. I don't like paying taxes like anybody else. It's one of those things you have to do. Obviously, it's always good to reduce your taxes, but then again, here's a caveat. Especially if you're still going out for loans, you have to be you kind of have to balance between paying no taxes, which is what I think everybody wants to do. But also, if you're applying for a loan, then many times for investors, we have to provide tax returns. So it's important that your tax return reflect that you're actually making money. Otherwise, the lender will say, well, you're not making any money, and therefore you may not get the loan. So speak to your CPA about making sure you have the right balance between paying taxes, but also demonstrating that you have a business that's actually making money. So your tax returns do serve multiple purposes, especially for real estate investors who are trying to scale their portfolio. So if many real estate investors, especially those new to the game, struggle to understand how to leverage the tax code to their advantage. But what if a few tax strategies that you can probably use and implement? I don't know if we're having issues with the connection. Hopefully everybody's able to join me, because it seems like people are joining but getting disconnected. So I'm not too sure exactly what's going on, but I'll just keep on going. If there's any issues, please put them in the comment box, and I'll try to get them to you. Anyway, so again, if you've got any questions, put them in the chat box. Also, if you want to book a one-on-one with me, you can always go to my website, www.joeasamoah.com, www.joeasamoah.com, my website, and you can schedule a one-on-one with me at that time.
I'm having trouble connecting to the internet. It looks like an issue with the router and Echo device.
I hope
so
that
try
you can hear me.
them.
Sorry about that.
Unplug both of them, then plug the router back in.
Alexa.
Wait 30 seconds. Once the router is back connected to the internet.
Once Alexa has finished, then I'll continue. Okay, she's finished now, so let me continue. So understanding the tax benefits and considerations available to landlords really is important. It's not just about avoiding costly mistakes. It's really one of the most powerful levers that you can pull to build long-term wealth through residential real estate. So if you can save on your taxes, what it does mean is that it then gives you some money to do other things, like to save and then build up a reserve and then buy more houses. So again, before I do a deep dive today, I do strongly suggest that you do seek the counsel and wisdom of a CPA, a bookkeeper, who can analyze your specific situations and best provide you with specific guidance and advice given the circumstances that you have. Okay, so let's get going now. I suppose the first thing is, what tax deductions are available to landlords and how can they be maximized? So one of the biggest things is depreciation. That's one of those things that real estate investors do have access to. It's one of the benefits of owning real estate is that depreciation, for those who don't know, is one of the most powerful yet underutilized tax benefits available to landlords. It allows property owners to deduct the theoretical wear and tear on their investment properties over time, even if the property value is increasing. So depreciation, you can, from a tax standpoint, the property, the asset is going down in value, you're depreciating it. However, we all know that especially if you buy in the right area, the property is actually increasing in value over time. So savvy investors, calculate depreciation annually and include it in their tax strategy to lower taxable income significantly. Another significant benefit that you may want to, or an essential benefit, is mortgage interest. For most investors, we leverage our properties, and for a lot of people, the mortgage expense is the interest expense on the loan is the biggest expense that they have. So the IRS does allow us landlords to deduct interest paid on investment properties on loans used to acquire or even to improve rental property. So combine this with deductions for things like operating expenses such as repairs, property management fees, insurance, and utilities. As you can see, there are quite a bit significant benefits, through real estate that you can reduce your taxable income. And as I said before, experienced investors like you and I often work with a CPA to review expense categories that may be overlooked, such as things as travel to and from the property, home office use, or even legal and accounting fees. So maximizing these deductions requires excellent record keeping. You don't want to just throw stuff in the shoebox and just get it out at the end of the year or during the tax season. It requires excellent record keeping. Again, I have a bookkeeper who I use. She reconciles all my accounts every month. We use the software QuickBooks, or she uses it, and QuickBooks Online is that what we use. And so excellent record keeping and planning, can be pay off, especially if you're organized. So what are some of the action items associated with deductions available for investors and landlords? Track and categorize all your expenses related to your property. Categorize them. If it's in, QuickBooks has this feature called, what do they call it? They call it classes. And so if you've got two properties, you got class one, which is one property. Class two will be a different one. So any expenses that you have, you sort of categorize them into classes. So it's easier to track all the expenses per property. And so it's a lot more organized. And then you want to put different categories, whether it be interest, whether it be utilities, whether it be so many different categories, repairs and so forth. And that way you can organize all your activities accordingly, and it makes it easier for your CPA at the end of the year to do your taxes. So consult with a tax professional annually to uncover missed deductions, and deduct mortgage interest and consider refinancing options to maintain deductible interest levels. Okay, so that's number one. I've got 6 sections today's session. So we've done number one, which is what deductions are available to landlords. Number two is how does the entity structuring impact landlords' tax obligations and protections. So a lot of us own real estate either in our personal name, or we use LLCs or entities anyway, to be specific. So choosing the right business entity, whether it be an LLC, S Corp, or holding the property in your personal name, can have major tax and legal implications. It is what it is. I know everyone tells you to always buy properties in LLCs or entities. That just depends. I have properties, different entities, personal names, and so forth. And there are pros and cons with each. And what I don't recommend is people saying, well, I'm not going to buy a house until I have all my LLC, sorted out. I have a Nevada LLC, which is connected to a Alaska entity, which is connected to a Wyoming, and all this kind of complicated tax strategies. That's all well and good, but let's just get some assets first. And then we can then figure out how to protect those assets, once we have them. So a lot of people kind of, I would say, waste time or defer taking action until all the stars are aligned in terms of the LLC structures and things like that. But there are, tax and legal implications on how you own your assets. Many people, create separate LLCs or separate personal and business entities. And but either way, the entity that you choose, it will have an impact on the taxes that you pay. So, for example, LLCs offer what we call pass-through taxation, which can help you avoid what we call double taxation, but also means that your rental income flows directly to your personal return through your 1040. Again, I don't want to go into the weeds today, but there are pros and cons with owning, assets in different entities. So some investors structure their portfolios using a holding company with multiple LLCs beneath it to compartmentalize the risk. And some people use S corps for properties that generate significant income, allowing for salary and dividend optimization. But again, either way, what you don't want to do is to commingle funds, i.e., put personal and business expenses into a bank account. This can lead to red flags and possibly loss of legal protections, and you're a candidate for, or a possible candidate anyway, for IRS audits. So the key is to align your structure with your long-term investment goals and what makes the most sense for you. So speak to other landlords, go to RIA meetings, find out what other people are doing, and then you can possibly adapt based on your situation. Obviously, if you are new to real estate investing, you're going to have different considerations than if you have multiple properties in a large portfolio. So it's not a one-size-fits-all. Speak to others, seek counsel, and hopefully you'll get the one that makes the most sense for you, whether it's owning in your own personal name or whether it's owning in different entities, whether it be LLC, S Corp, C Corp, etc. So what are some of the action items? Evaluate your current entity structure with a real estate savvy CPA or an attorney. Separate your business and personal finances to maintain legal protection, and also reassess your structure as your portfolio grows or your tax law or the tax laws changes. So again, as you grow, hopefully, then you can sort of revisit where you are and then make changes accordingly. Okay, so let's go on to number 3. Again, if you've got some questions, put them in the chat box, and I'll try and get to them. Well, I will get to them shortly. Number 3, how can landlords leverage passive activity loss rules to their benefits? So the IRS classifies, my understanding, they classify rental income as passive, which means that losses are generally only deductible against other passive income. However, exceptions do exist. If you actively participate in rental activities and earn less than 150K, you may be able to deduct up to 25K in losses against ordinary income. Again, I'm not a CPA. This is what my understanding. I could be wrong. That's why you do want to get advice from others. But that's my understanding. If you're what we call a real estate professional, those who materially participate and spend over 750 hours annually on their real estate activities, then you can unlock even greater benefits. You can deduct unlimited losses against ordinary income, making this really a game changer for full-time real estate investors. Or those who have a spouse, that's another strategy. If you have a spouse who may spend, who may be able to qualify under this rule. The challenge is really documenting participation and understanding thresholds. So many people do miss out on this deduction simply because they don't track their hours. If you can track your hours, you may be able to qualify, or sometimes people just misunderstand the IRS rules. So again, speak to other people, speak to your CPA, speak to counsel, and they'll advise you whether you do qualify for some of these benefits that you can through real estate investing. So experienced landlords, they do log their hours, and they do seek counsel and to adjust their sort of strategy based on what the end game is. As I said before earlier on, sometimes it's not always good to have zero taxes or you have a lot of losses, especially if you are trying to apply for loans, because many lenders want to see a copy of your tax return. And if you all you're doing is just having losses, then in their eyes, you're running a non-profit organization. You're not making any money, so you're at high risk. So it's a double-edged sword, and that's where you want to make sure that your strategy is consistent with the end game. You may have to show you're making money, which then allows you to qualify for loans and therefore build up your portfolio. So what are some of the action items? Track your hours spent managing and working on your properties. Determine if you or your spouse qualify as a real estate professional. Use exemptions, 25,000 exemption if your income is below IRS limits, and consult with a tax advisor to ensure correct passive loss reporting. Okay, so kind of halfway through. As always, if you've got any questions on this topic or anything to do with real estate investing, I know it's kind of a dry topic, but I wanted to talk about taxes because it's April and many people are now, think about taxes, or at least taxes is on their radar screen. So I wanted to have a session on that. It's not sexy. It's not, gee whiz. It's just taxes. So put your questions in the chat box. And if you want to book a one-on-one with me, you can always obviously go to my website, joeasamoah.com, and then you can schedule a one-on-one. I had a session today. It's a fantastic session with Lawrence. We talked about some of the things that, he has a property, and we were talking about inspections for Section 8. We talked about strategies to grow his portfolio, which is what he wants to do. And also some of the issues that he had with, or he's having with one of his tenants. She's behind on the utilities. She's behind on his rent. And so we kind of strategize on how he can kind of turn that thing around. And it gave me some really, really good advice based on my experience and based on what I'm doing. Also, we talked about inspections for maybe trying to incorporate inspections, not the Section 8 inspections, but inspections so he can gauge or he can confirm that the tenant's actually taking care of his property. Because many times as landlords, we're collecting rent, but we don't know if the tenant's taking care of our house, or if there's damage, and so on. So I've got pretty creative ways, which I'm implementing on how I can keep tabs on my tenants and really incentivize my tenants to do the right thing. So they, in addition to paying their rent, they're also protecting my, my investment, the asset, the property. They're making sure they're happy, and hopefully they can stay a long time so we can reduce tenant turnover. So that's what we talked today with Lawrence. Again, if you've got anything to do with real estate investing, questions, issues, challenges, problems, you can schedule a one-on-one with me, and we can kind of do a deep dive based on your situation. And they're really good. I'm really enjoying it. I think everybody that attends, at least books one of the sessions, have found it to be very, very helpful. Okay, moving right along, let's get to number 4. What records should landlord keep to stay compliant and audit ready? What records, should landlords, you and I, keep to stay compliant and quote unquote audit ready? I've been through it. IRS audit. It wasn't pretty. I got through it. I had a great CPA, and in fact, I ended up getting more money back than paying money. Originally, they told me I owed them money, and after the audit, my CPA was able to get a refund from the IRS. So she wasn't afraid of the IRS at all. She went in there and provided all the documentation, but it was because of good record keeping. She was able to do that for me. So so record keeping isn't glamorous, but it's really non-negotiable if you want to take full advantage of tax deductions and to avoid penalties. Every expenses that you incur should be backed up by a receipt, an invoice, or some kind of bank record. There should be a paper trail, and therefore, if you do get audited, you can sort of justify by providing supporting documentation. Digital tools like QuickBooks or property management software nowadays make this even easier than ever. I mean, with QuickBooks, you can generate reports, you can track things, you can do what-if scenarios. It's a fantastic tool. But also, there's lots of different property management software that you can use that also helps you track your inflows and outflows. So successful landlords often have organized systems for logging miles. You can get your miles deducted, capturing receipts, and also tracking rent payments, so tracking your income and your outflows. We try to create a paper trail that proves that the business purpose of each deduction. In contrast, landlords who neglect documentation can lose deductions or even face hefty IRS penalties during an audit. It's really important to be able to support any deductions that you're taking with good documentation. So beyond expenses, maintain records for income received, lease agreements, insurance documents, and communications with tenants. Put them in electronically, store them either on your desktop or your laptop or on the cloud, because these files protect you, not just at tax time, but also in any kind of legal dispute. I have an assistant that comes in and also scans all my documents, so all the documents are electronic, which makes it easier to access, if and when you need them. So what are some of the action items associated with record keeping? Use these digital tools or apps to organize receipts and expenses. Maintain a dedicated business account. And back up important files in the cloud and maintain access for at least 7 years. Maintain access for at least 7 years. Moving on to number 5. I thought I'll touch upon this, 1031 exchanges. It's a strategy that many investors use to defer, help defer taxes and also grow your portfolio. I'm just going to cover this on a very, very high level. There's a lot to 1031 exchanges beyond the scope of today's session. But essentially, a 1031 exchange allows landlords, investors to defer capital gains taxes when selling a property, as long as they reinvest the proceeds into a similar, or what we call a like kind property. Okay, so this powerful strategy can really supercharge your portfolio growth by freeing up more capital to reinvest. So what does that mean? Seasoned investors use 1031 exchanges to upgrade properties, consolidate holdings, or shift into more profitable markets, or even grow their portfolio. However, the process, is a little complicated, and there are time-sensitive requirements. For example, you must identify what we call a replacement property, property that you're going to buy within 45 days, and close within 100 180 days, from the sale of your initial property. Investors who failed to meet these deadlines or didn't use what we call a qualified intermediary, you can lose the opportunity and you can end up paying the taxes that you otherwise would have saved. So learning from these missteps can prevent costly errors. So proper planning and working with professionals is really key to a successful tax-deferred 1031 exchange. So again, maybe I'll do a session on 1031 exchanges. It's a strategy I haven't used, but it's a strategy that a lot of investors that use. So rather than selling a house, getting the proceeds and paying taxes on it, you can defer the taxes or the capital gain, and therefore you can plow those savings into, growing your portfolio. So what are some of the action items associated with 1031 exchanges? Understand, take some time if you're if you want to save tax on any sales of properties, or if you want to grow your portfolio. You may want to take some time and try to understand, the concept of 1031 exchanges, especially things like timelines and the requirements. They're very, very specific, and you have to adhere to them. So identify what we call a qualified intermediary before selling the property. This is sort of the middleman or middlewoman, I suppose, who handles the transaction so you don't get any of the proceeds. Okay, it has to be a qualified intermediary, and you should also work with an agent and an attorney that's experienced in 1031 exchanges as well. So plan your next purchase before listing your current property. And finally, number 6 is let's have a look, 7:30 now. What tax mistakes do landlords commonly make, and how can you and I avoid them? Okay, what are the most common mistakes that investors and landlords, especially buy and hold investors, commonly make, and what are some of the things we can do to avoid making those mistakes? So from missing deductions to poor record keeping, many landlords leave money on the table or expose themselves to an IRS scrutiny, possibly an audit. A common mistake is treating rental income casually. Treating rental income casually. What does that mean? Failing to set up business accounts, skipping quarterly estimated taxes, or misclassifying expenses. I talked about classifications earlier on. Some expenses are deductible and other expenses are not. But if you classify them properly and you track them properly and you have supporting documentation, then your CPA, your tax preparer, will be able to advise you on what to do and how to treat other various expenses. So, your income and also your expenses. Another one is failing to plan for major repairs or unexpected vacancies. Taxes are due. Repairs are due, or you incur them, and vacancies, are incurred as well, especially if you don't implement my strategies, which is all designed to reduce turnover costs. These cost money. These expenses, it could lead you to cash flow, challenges, that can have an impact on your tax situation. Another thing is that some people don't simplify or consult a tax advisor until it's too late. You don't want to wait till you get a letter from the IRS before you speak to your advisor. You want to implement strategies whereby you can be proactive beforehand, and therefore you can work in tandem with your advisor or preparer to have a game plan. So learning from those who face audits or penalties really shows that proactivity and education can really make a difference. As I said to you, I was audited. It was a pretty detailed audit, and fortunately I had a good CPA who was able to defend me, I suppose. It was a full-blown audit where the investigator in fact came to my home and make sure I had a home office and and all that kind of different things. And then the CPA, we had the actual audit itself at the CPA's office, and she took care of business. So savvy landlords automate payments, set aside reserves for taxes and repairs, and create an annual tax planning meetings with their CPA. Okay, these small but consistent habits help maintain compliance and hopefully profitability. So what are the action items before I wrap this up? Treat your rental as a business, not as a side hustle, as a business, as income and expenses. Set up financial reserves for taxes and maintenance. Things happen. Make sure you have the reserves to take care of it if and when it happens. Schedule a tax planning session before year end with your CPA as well. And finally, conclusion for today is I strongly suggest that you seek the wisdom and counsel of a CPA who can analyze your situation and best provide you with specific advice and guidance. Because in the world of residential real estate, mastering tax strategy isn't just a nice to have. It's really essential for long-term success. The tax code provides a toolkit full of benefits or for those who take the time to understand and apply them. So from leveraging depreciation and mortgage interest deductions to properly structuring your entity and executing a 1031 exchange, each decision you can make can have a significant impact on your bottom line. So what separates the thriving investors from the struggling ones often comes down to how well they manage the tax side of their business. While it may seem complex, and it is at first, the path becomes clearer with education, expert advice, and a willingness to adapt. So every seasoned investor once started, where you are, we all had to start somewhere. And, it does pay itself forward and by embracing tax planning as part of your strategy. So if you're ready to move beyond just collecting rent checks and start building true generation wealth, don't overlook your taxes. There, my friends, is it for today. Let me go to Q&A, I suppose. So if you got some questions, please put them in the chat box and I'll get to them shortly in a few minutes. If you want to shoot me an email, you can shoot me an email to joe@joeasamoah.com, joe@joeasamoah.com. And if you want to book a one-on-one with me, you can go to my website, www.joeasamoah.com, where we can do a deep dive into your situation, whatever it is. So let's get down to questions. I know it was a little dry, I get it. It's not a sexy topic, but I think it was appropriate given the fact that we're in what do you call it? April, getting ready for April 15th tax time and so on. Okay, so let's have a look. We got first question is from Kanatu. Hope I pronounced it correctly. And let's have a look. What are you seeing increased costs for renovations? Yes. Everything's going up. The cost of materials is going up, lumber and, supplies. And what used to be a pretty straightforward rehab, maybe 100K is now 125 to 130K. What used to be 200 now 250. It's very hard to do rehabs cheap. That's the materials. On the other side is the cost of labor. That's also gone up as well. Things really went up during COVID. It really jacked up the prices for most rehabs. And for the most part, prices haven't gone down since then. I suppose with President Trump's announced for tariffs today, I expect that prices will go even higher. So it's going to be tough. And so, embrace yourself for higher costs for renovations. And sometimes going for the cheap guy is not always the best strategy. I know there's a temptation to go with the cheapest contractor. But sometimes you get what you pay for. But yeah, prices are going up by for the renovations that I've noticed in the last year or two, really the last 4 or 5 years. Especially if you go to a place like Home Depot, Lowe's, and you kind of see what their prices are for materials. It's getting kind of crazy. Okay, keep going again. Put your questions in the chat box and I'll get them to them shortly. Godfred Wachi Osei. Godfred. That's a Ghanaian name, obviously. And I'm not sure where you got a British flag there, so I don't know if you're in England, Godfred. Anyway, nice to meet you, Godfred. If you got some questions, put them in. I think you got a question now, so let me get to your question in a second. Amon, hope you're doing well. Okay, next one. From Nesta Can. Hey, Joe, how much should you charge a Section 8 tenant for a security deposit? Do you do first month's rent plus deposit? This is a tricky question. It depends on your state laws. But most jurisdictions, the security deposit is 1 month's rent. So if the rent's $1,000, then typically to move into the property, it requires 1 month's rent, which is $1,000, and 1 month security deposit, which is $1,000. So you're going to, typically you'll request $2,000 from the tenant before they can move into your property. $1,000 to pay the first month's rent, say April, and then $1,000 to pay the security deposit in the event that damage is done or there are charges that you want to offset from when they vacate the property. So that's most of the time. I'm not too sure if Section 8 has a policy on that one. That's something you may want to check in on your local housing authority where your property is located to make sure that you're compliant with their policy requirements and the state laws, local laws, and so on, and federal laws. So, but typically I charge 1 month's rent as a security deposit. Now in Washington, D.C., sometimes the housing authorities do pay for the security deposit, sometimes, not always, because the rents are quite high here. We're talking $3,000, $4,000, $5,000 for houses. So it's very seldom you have a tenant who's walking around with $3,000, $4,000, $5,000. So the housing authority realizes that they need to assist or help voucher holders to get into these properties. Otherwise, they'll never get into properties because they just don't have the money, or they have to set up a payment plan. So if your tenant doesn't have all that money up front, then you're going to have to use your discretion on whether you have established a payment plan. So they have like partial payments, maybe $250 or $500 a month until the rent is paid up, and so on. So again, that's on a case-by-case basis. I've done that several times when I have a really, really good tenant who just doesn't have all the money up front. So I try to work with them. Godfred, is it okay to buy cheap houses which still cash flow as a starter? Is it okay to buy cheap houses? Well, that's a complicated question. Godfred. The reason why I say it's complicated is that cheaper houses tend to be in cheaper areas. I gotta be careful what I say here. And sometimes the cheaper areas is not where what I call tier 1 tenants want to live. Okay, so what I mean by that is that I know the stereotype is that Section 8 voucher holders will live anywhere. They'll take anything because they're quote unquote Section 8 tenants. Well, I don't agree with that. There's a group of people you hear me talk about, which is what I call a tier 1 Section 8 tenant. These are the creme de la creme of the voucher holders. Now, these folks at the end of the day are no different than you and I. They don't want to live anywhere. They don't want to get shot at. They don't want to worry about safety. They're concerned about their children, the safety of their children. I mean, they're concerned about all those things that you are concerned about. Really, the only difference between them and you is that they may not have that much money. But in terms of their goals, aspirations for their family, for their children, it's really no different than you and I. So, there is a temptation to buy in cheap areas because, quote unquote, you get higher cash flow because your debt is lower, because the cost of acquisition is less, so therefore your mortgage is less, and the rents are, when you do a ratio of rents to mortgage, is pretty good. So you're thinking you're going to make all this cash flow, but the problem is that in cheap areas, a couple of things. One is because it may not be the safest area, it's harder to find tenants who want to live there. Okay, not everybody wants to live in a neighborhood where you get shot at, where you have to worry about crime. You got a whole bunch of drama going on. Not everybody wants to live there. After a while, you kind of get tired of that, especially if you have a lot of children, and your safety of your children is paramount. So not everybody wants to live in these cheap areas. And the other thing is that the downside is that when they do move there, your tenants, many times they don't stay that long because the way Section 8 works is that the rent that they pay is based on their income. So whether they live in a C, D, E neighborhood, their portion of the rent is the same. So obviously, if your rent's the same, whether you live in an A, B, C, D, E area, you're going to gravitate to the better area. So if you have the opportunity, so you tend to find that people leave, or they don't stay that long as they would if you buy in better areas. So and so that's what I've learned anyway, Godfrey. So I tend to buy. I mean, again, I'm not talking about buying in Beverly Hills. It's not necessary. You just want to avoid buying in quote unquote bad areas because it's harder to find quality tenants, and once you do find them, it's harder to keep them. So you have higher turnover, and turnover costs are very, very expensive. So you end up, the cash flow that you make gets wiped out due to the turnover costs and also the hassle factor that you sometimes get, in cheap areas. So, it's up to you, Godfrey. Is it okay to buy cheap houses, which cash flow is a starter? I'm going to leave it up to you. I just learned my lesson, and I'll give you my experiences. Sometimes it's better just to pay a little bit more to be in a better area. Yes, you're going to pay a little bit more. Yes, your cash flow is going to be less, but you end up, better off over the long haul because better areas tend to appreciate more. Better areas tend to attract better quality tenants, and better areas, once they do come, they tend to stay longer. So feel free to, give me your take if you agree or disagree. But that's been my experience. I'm all about trying to keep tenants to stay a long time. I don't want turnover because you're thinking you're making money, but the turnover cost will wipe out all the cash flow. In fact, you can make less. You can make more money, by charging. If somebody's example, if let's say somebody is charging a rent of $1,000, and I charge 900, so my rent is lower, or even 800. But because I can control my turnover costs, I can end up netting more money than the person paying higher rent, because the other person will have higher turnover costs, and turnover costs typically is 1, 2, 3 months lost rent. So when you kind of amortize it or average it out, if you can't control your turnover costs, you really don't make any money. Okay, good. Hopefully I answered the question, Godfrey. COVID was a game changer for us too. Yeah, it was. It was a game changer. Everything changed during COVID times. Prices especially went up. There was lockdowns, and it was challenging. Especially if you didn't do Section 8. So a lot of people lost their jobs. They're in lockdown, and they couldn't pay their rent. There was rent strikes. I mean, you remember those days? People saying, why should I pay rent? Or it's almost impossible in some places to even get rid of tenants. You couldn't take them to court. So, a lot of landlords lost a lot of money. I survived that because I had Section 8. The Section 8 income continued. And if a tenant lost their jobs, then they will go to the housing authority and they request a rent reduction. And so their tenant's portion may go down, but the housing authority's portion went up. So I wasn't impacted as much as other, especially market renter landlords, were during that COVID time. It was rough. There was rent strikes. It was impossible to get rid of some tenants. And if they didn't want to pay you, there's really not a whole lot you could do about it. It was ugly. And that, some people are still having the effects of that as well. So Section 8. Yes, Agania. Yes, yes. Where are you based? You got a British flag there, Sir Godfred. So I don't know if you're in England, you're in Ghana. I was in Ghana earlier this year, as you may recall, in January. And hopefully, God willing, I'll get a chance to go back there again. So far, I've done 3 countries this year: Ghana, Trinidad and Tobago, and now Mexico. So I've still got 3 more countries to do. So hopefully I'll try to go to Ghana and go to other places. So keep posted. Okay, so Nestor. Yeah, you're right. I purchased a property in Cahokia section on Illinois. I'm not sure where that is. I bought it for $28K. It's in a bad area, and I had to evict 2 tenants so far. So I agree with you. I'm glad that you concur with me, Nestor. Sometimes buying in cheap areas, I mean, in theory, you should make cash flow, but the problems that you encounter, sometimes it's just not worth it. There's a lot to be said for what I call peace of mind. You don't have to worry about drama, chaos, confusion, evictions, tenants from hell. After a while, life's too short, and you want to kind of, keep your sanity, I suppose. So I know there's a temptation to buy in cheap areas. As Nestor was saying, he bought in the Cahokia section. I'm not too sure where that is in Illinois. He got it for $28K. I mean, $28K is cheap, and it's in a bad area, as he says. And already he's had to evict 2 tenants. Evictions are very expensive. If you can't do it yourself, you got to hire an attorney. And typically, when a tenant gets evicted, they tend to destroy the house on the way out. And there's no winners in eviction, believe me. I've learned the hard way. Fortunately, I haven't done an eviction in about 12 years now. 10 to 12 years, I think. That's the last time I did an eviction. I mean, there's ways to avoid evictions. And maybe I'll do a session on that one. If you think it's a good idea, let me know. Maybe I'll do a future live stream on how to avoid evictions strategies. As I think Charlie Munger was said, this is where I am, my real estate investing. I'm not, I rather not solve problems. Okay. I rather not have problems, to tell you the truth, and have to solve problems. So, the best way to not have problems is to avoid problems. Okay, I hope that makes sense. The best way to not have problems is just to avoid them rather than solving problems. Okay, I mean, it's good to solve problems, but why solve problems if you don't have to, if you can avoid them in the first place? So most landlords, investors, most problematic is primarily, most of the problems you have are tenant related. I mean, yeah, something goes wrong with the house, the plumbing goes down, the electrical. I mean, those things you can, fix, or you can get someone to take care of it. It's the tenant issues that are the most, frustrating. If you can't screen well and you can't get the right person in your home, it's horrible. And so most of your problems are just down to you just got the wrong person in your house. That's at the end of the day. So if you can avoid all those nonsense, then you can really enjoy being a long-term investor, a long-term landlord. I really do enjoy it. It's a blessing, this business. You're providing quality housing to families, and but it's really a blessing when you have good tenants. It's not a blessing when you have tenants from hell, believe me. So let's have a look. Okay, so I've just done that one. Yes, I've gone in. And let's go to Nestor. Yep, I've done that one. He agrees. So well done, well explained. Thanks very much. Yes, I am in England now. It's been a while. I went back to Ghana. I may visit too. Okay, Godfred. Godfred, have I met you before, Godfred? You're in England, so I don't know. I used to live in England. In Walthamstow and Leighton in London, for those people who know England. It's in the east or northeast side of the city in E10 and E17. Anyway, yeah, I passed through London, in fact. What's it called? Not too long ago, on my way back from Ghana. Okay, so to book a one-on-one, go to my website. Let's have a look. What's this one? DCC. We've appreciated learning your approach to Section 8. Are you still optimistic, or does this moment feel like a more serious threat that we've seen before? I know you've seen a lot. Yeah, that's a good question, DCC. I mean, who knows what's going on these days? I mean, it's like every day there's drama going on. Every day there's news going on. It's chaos, confusion. Doge, DOGE. I mean, they're cutting funding. I do expect HUD to have their funds cut. They will. And it will impact the Section 8 program. This may be a little different than before, but generally, when they've had their fundings cut before. This is not the first time. And it usually plays out in different ways. So the HUD has their money or funds cut, and they then pass it down to the local housing authorities where you are located. So it's going to be implemented, the cuts, locally by the housing authority. And so they may do different things based on, politics in the local area and things like that. Things I've seen in the past in situations like this are as follows. One, they don't allow rent increases. So if you want a rent increase, you better apply for it right now. Hopefully you'll get it before they have their funding cut. Two, they don't issue out new vouchers. So they don't give new vouchers. So the wait list gets longer. People aren't able to come into the program. Three, for those people who are in the program, because funds are cut, either the tenant's portion goes up, or they tend to look for reasons to get people off the program. So if there are tenants who aren't complying with their requirements, like paying their utilities, paying their rent, recertifying, they're going to look to get them off the program. So it's really important for you to stay on top of your tenants to make sure that they're complying with the program policy requirements, because they're looking for people to possibly terminate from the program. So they're going to punish the bad actors, voucher holders, and reward the good actors. Those people who are doing what they're supposed to do, they should be okay. But the ones who are kind of trying to get over on the system, they're the ones who I'll be concerned about. Four, I suppose, five, I think it is. I'm on that right now. Is that if funds are cut, then typically they cut staff at the housing authorities. So if they cut staff, then you have less people doing the same work. So it's more bureaucratic. Stuff takes longer to get done. And the lesson learned is that now is the time to start developing relationships with people at the housing authority, because if you want stuff done, there's fewer people, and those people are more overworked. So if you don't know anybody, they may not get to you, and so on. Okay, Dow 2. Did the voucher program pay this month? Yes, they did. I got mine yesterday. For whatever reason, the voucher program is not paid yet this month. I got mine payment, at least in DC and the DC area. I got my payments. I'm not too sure. I don't know what happened where you are. I think you're in Phoenix. So my money came in without a problem. There's never been a month where I didn't get my payments. I have contacted them, but I have not gotten a response. I'll definitely email. Again, this is where relationships come in. If you know people down at the housing authority, you can get the answers to your question a lot easier than if you don't know anybody and you're just waiting for some bureaucrat to get back to you. But definitely I always chase that up, Dow too. But I didn't have any problems getting my money this month. In fact, I've never had a problem getting any of my money. Screening is very important. I agree with you. Do you have any particular website or companies that you recommend for tenant screening? In fact, I do have a course on tenant screening that you may want to consider. Purchase an online course. If you go to my website, I think you can, what's it called? Go to my website. It's the tenant screening toolkit. I think the course. No, tenant screening playbook. tenantscreeningplaybook.com. tenantscreeningplaybook.com. It's an online course. You may want to check that out. Otherwise, there are ways to screen. I mean, I'm going to do a session on screening alone, so maybe we can talk in more detail about how I screen. I do a very, very thorough screening. If you screen wrong, you are dead in the water. That's all I can say. It's hard to get rid of people once they're in your house. What screening does is allow you to avoid getting the wrong person in your house in the first place. As an encouragement, I read Project 2025 housing section, and they both want more homeowners, but want more landlords to join the program. So it's a plus and minus for us long-term holds. Yeah, I'm not really that worried. I mean, it is what it is. I mean, it's a new political environment. We have, we'll get through it. I've got through 30 years of these guys. One thing I do know, unless they're going to be okay with putting women and young children on the streets, because that's the population we tend to serve. I can't see them eliminating this program. So there's a housing crisis already. To throw out, women and children, I don't think it's good PR. But who knows? But there are things that we can do, and maybe I'll do a session on that as well. Strategies for surviving, budget cuts through Section 8 program and things like that. Anyway, it's 8 o'clock. I'm gonna wrap it up, and again, I had a good session. A lot of good questions, and so I'll see you next Wednesday, 7 p.m. Eastern time. I'm going to be in town. I'm not going anywhere for the next few weeks, so it'll be another live session, and I'll see you next Wednesday, 7 p.m. Okay, have a good one. Take care. Bye for now.